In the intricate world of investing, numbers, graphs, and trends aren't the only players on the board. Hidden beneath the surface of financial decisions are deep-seated psychological biases that silently steer our choices, often without our conscious awareness. These biases, often rooted in evolutionary history and cognitive shortcuts, impact everything from how we interpret information to how we react in the face of gains or losses. For investors aiming to navigate the turbulent waters of the financial market, understanding these biases is not just beneficial, it's critical. Before we get started, if you'd like to join a stellar investing community, sign up for a premium membership at the link in the description below. Let's get started. Incentive-caused bias. This bias highlights our knack for directing people towards what benefits us. It's the proverbial carrot dangled in front of a horse, skewing motivations and influencing decisions. Incentive-caused bias plays a pivotal role in the investment landscape, driving decisions based on personal or financial gains rather than objective evaluation. Whether it's financial advisors leaning towards products that offer them higher commissions, company executives taking actions to boost stock prices due to stock options, investors sticking with choices to validate their public endorsements, mutual fund managers chasing short-term returns due to performance evaluations, sales teams pushing products aggressively to meet targets, or companies using promotions to sway consumer behavior, the underlying theme is clear. Decisions can be skewed by the allure of personal benefits. For prudent investment outcomes, recognizing and mitigating this bias is essential, necessitating transparency, governance, and continuous self-evaluation to ensure choices are made in true alignment with long-term value rather than immediate incentives. Recency bias. Recency bias, in the world of investing, refers to the tendency of individuals to prioritize and base decisions on the most recent information or events, often at the expense of historical data or long-term trends. This cognitive shortcut can lead investors to make impulsive decisions based on short-term market fluctuations, headlines, or recent economic news, potentially sidelining more holistic strategies grounded in comprehensive analysis. It's a reminder of human nature's inclination to react swiftly to the here and now, which, while sometimes advantageous, can also cloud judgment in the financial realm where a broader perspective often prevails. For savvy investing, recognizing and counterbalancing this bias is essential to ensure a more balanced and informed approach to market dynamics. Anchoring. Ever been influenced by the initial price tag you see? That's anchoring at work. Our brains often cling to the first piece of information, skewing subsequent judgments. Anchoring in the investment sphere refers to the cognitive bias where individuals give disproportionate weight to the first piece of information they encounter, often using it as a reference point for subsequent decisions. For instance, an investor might fixate on the initial price of a stock when they first encounter it, influencing their perception of its value in the future, regardless of market changes. This mental anchor can hinder accurate assessments and lead to missed opportunities, as investors might perceive a stock as overpriced or underpriced, based on an outdated or irrelevant reference point. Recognizing the influence of anchoring is crucial in the financial domain, urging investors to constantly reassess their reference points and ensure that decisions are rooted in current and comprehensive data rather than being tethered to initial impressions. Regression. Our obsession with cause and effect relationships can often blind us to the simple statistical reality. Things often revert to the average over time. Regression, in the context of investing, pertains to the human inclination to seek cause and effect patterns, even when none might exist, overshadowing the statistical principle that values often return to their mean or average over time. For instance, if a stock performs exceptionally well for a brief period, investors might attribute its success to recent company decisions or market events, when in fact, it might just be an outlier preparing to revert to its historical average. This bias can lead investors to make ill-informed choices, expecting continued extremes rather than anticipating a return to normalcy. A keen understanding of regression reminds investors of the importance of broader trends and historical averages, promoting decisions grounded in comprehensive data rather than fleeting anomalies. Hindsight bias, often labeled the "I knew it all along" phenomenon, relates to the tendency of investors to believe, after an event has occurred, that they had accurately predicted it, when in reality, its outcome was far from certain at the outset. In the investment realm, this can lead to overconfidence in one's predictive abilities and may cause investors to overlook potential risks or not take necessary precautions, assuming that past successes were solely based on skill rather than a mix of skill and luck. This bias can cloud an investor's judgment, making them prone to repeating decisions without adequate analysis simply because it worked last time. Recognizing hindsight bias is essential for investors to maintain a grounded perspective, ensuring that strategies and decisions are consistently evaluated with fresh eyes and not merely through the lens of past events. Halo effect. This bias paints a black or white picture. We tend to entirely like or dislike someone or something, blurring nuances and details in between. In the investing world, this might manifest when an investor, impressed by a company's recent success or a charismatic CEO, overlooks potential weaknesses or flaws in its business model. Conversely, one negative event might overshadow several positive aspects, leading to undervaluation. This simplification into a good or bad binary can obscure critical nuances and details that are essential for a well-rounded investment decision. To navigate the financial markets effectively, it's imperative for investors to recognize the halo effect and strive for a more balanced and comprehensive evaluation of assets, free from overarching generalizations. Loss aversion is a psychological phenomenon where individuals feel the pain of a loss more acutely than the pleasure of an equivalent gain. In the realm of investing, this can lead investors to make suboptimal decisions. For instance, they might hold on to a declining asset for longer than they should, hoping it will rebound, simply to avoid the emotional pain of realizing a loss. Conversely, they might sell a winning asset too quickly to lock in gains and avoid the potential pain of future losses. Additionally, this bias can make investors overly conservative, avoiding opportunities with favorable risk-reward profiles simply due to an exaggerated fear of loss. For effective portfolio management, it's crucial for investors to recognize and counteract the effects of loss aversion, focusing on the logical evaluation of risks and rewards rather than being swayed by the emotional weight of potential losses. Commitment bias. Ever stuck to a decision simply because you've made it in the past or voiced it out loud? This bias traps us in our past choices, making it difficult to adapt even when they're proving detrimental. Within investing, this bias can be particularly dangerous. An investor might continue to pour money into a failing venture simply because they've previously championed it or have invested significant sums already, even when clear evidence suggests a change in strategy is warranted. This can lead to a sunk cost fallacy, where the emphasis is on past investments rather than evaluating the potential for future returns. Such attachment to prior decisions can hinder portfolio adaptability, potentially leading to prolonged losses or missed opportunities. Recognizing and counteracting commitment bias is essential for investors to remain flexible and responsive to the ever-evolving financial landscape. Illusion of skill. Achieved something great? It's easy to ascribe it to skill, even when luck played a part. This bias can lead to overestimating abilities based on outcomes. For instance, an investor who realizes high returns from a risky asset might believe it was purely their financial acumen at play, ignoring market volatility or fortunate timing. By overvaluing their own capabilities based on select outcomes, individuals can become overconfident, potentially making them more prone to taking undue risks. It's essential to differentiate between genuine skill and fortuitous outcomes to maintain a balanced and realistic perspective on one's abilities and decisions. Consistency. Bias. A double-edged sword. This bias ensures we crave consistency in our decisions. While stability is good, this can also trap us into persisting with incorrect choices. For instance, someone might continue using an outdated method simply because it's what they've always done, even if newer, more efficient alternatives are available. This inclination towards the familiar can prevent individuals from adapting to changing circumstances or recognizing and correcting past mistakes. Striking a balance between valuing consistency and staying open to change is crucial for effective decision-making. In the financial realm, where fortunes can be made or lost in seconds, understanding these biases isn't just a matter of introspective curiosity. It's about safeguarding investments, predicting market behaviors, and ultimately, making informed and strategic decisions. The first step to navigating these biases is acknowledging them. The next? Constantly challenging our perceptions and beliefs, ensuring they're rooted in fact and not mere psychological illusions. Thank you for joining me today. Please like and subscribe if you've enjoyed. It really means a lot. Until next time.